As interest rates have moved lower and lower throughout the last few decades, the firepower of the central banks, particularly the Fed, has diminished. We are in a time in which the printing presses are running at full blast. Globally, all central banks are pumping in fiat garbage, and still the economy is horribly weak. Of course, this was already a problem in 2019 and into 2020. It was accelerated rapidly. But the question is, if they're already maxing out, what level will they go to next time around? You came here for the truth, so let me unveil that for you. We are already in a time in which nothing makes any sense. You see the amount of money that they're printing, you see the different operations that they are doing on a daily basis, you look at how far they have gone, and you compare that to what was going on let's say just a few years ago and all of the previous history before it, and my goodness, it looks like completely a 180, a complete spin. It is truly, and I'm using this word, I know it's abused today, but unprecedented, because when you see all of the different factors that have gone into this right now, there is no justification for what they're doing and what they say. They say one thing and they do another. And that to me is starting to be very telling, because if you look into this data as we will today, you are going to see the truth. I'm going to bring you so many statistics today. We're going to talk about SPAC, IPOs. We're going to talk about how the market has gone crazy, the margin, and all these different indicators which are showing this massive bubble and why the Fed cannot stop what's coming. Before I get into it, I want to be very clear, because there's an economic collapse that is absolutely a guarantee at some point in the future, simply because they create it on purpose. They do these on purpose. But there is a financial crisis that will have to be faced. And you could see this in any form. It could be something like a simple correction. This could really create something that is exclusive to, for instance, you had the March crash 2020, where everything started to fall all in sync, and we saw that basically globally. Everything happened at the same time. You could have real estate that goes bust. You could have financial assets that go bust. And it all depends. But when you see this, and time and time again this happens, when we hit a level of optimism that has never been seen before, it always goes to a record high. How much higher can it go before that turns on its head? That's what Jeremy Grantham was talking about in his recent interview with Bloomberg. It can only go so far, and then suddenly it turns around. So keep that in mind. US IPO revenues reached record levels driven by SPACs, total US deal value in the billions. Looking at what has come with all of these SPACs, it's simply a term that really, in many cases, means nothing whatsoever, but it has generated so much money for those on the inside of it. That's what a lot of the IPOs, in fact, are all about. It enriches the group of people getting in on the ground, and then afterwards, I mean, who knows what it's going to look like 10 years later, 20 years later. But I'm talking about, comparing it from those people that are sort of the originators, and then everybody else kind of gets in the frenzy, and they don't do so well as far as it goes with those people in the original group. SPACs can be a cash substitute when policy rates are low. You could see the red line, that's the Fed funds rate. And if you remember, it went up to almost 2.5%. And then look at what occurs. They bring those interest rates down to the floor, and suddenly SPAC capital raised. Oh my goodness. And why? Because the money is so cheap. Why not? When we saw the boost of silver prices just, recently, you look at what happened. The EPFR has this data, and you could see for yourself, weekly silver flow had been a record high. Never seen anything like this before. The amount of money going into it is unprecedented. I'm starting to dislike that word because of how overused it is. But looking at this, you could see the central bank liquidity going over top of the market cap of Apple, Amazon, Facebook, Google, Microsoft, Netflix, and Tesla, and it shouldn't surprise anybody. They're in the same direction, okay? The more money they print, the more it will find its way, that liquidity sloshing around in the system one way, shape, or form. Doesn't necessarily mean the Fed prints some money and then they buy the stock. No, it's not how it works. But the easier the conditions get, the more that certain stocks are going to benefit, and it's very, very clear right now. Speaking of tech stocks, the largest inflow into tech ever. And this is a group of stocks that's been seeing massive inflows over this period, and right now more money is going in than ever before. This should be a warning sign to everybody to pay attention to where the money goes. Follow the money, as they say. Okay, let's take a look at this weekly FICC flows as a percentage of the assets under management. And all I want to point out from this here, we're looking at the chart on the left-hand side, by the way, gold and silver topped the rest. Okay, bank loans, tips, mortgage-backed securities, and so on. This one certainly saw a lot of gains throughout this period just recently, and that information also comes from the EPFR. Real Investment Advice, one of my favorite sources, had posted a few charts here, some information that I think you would be interested in. Now, what we're looking at is events that come time and time again. They don't necessarily give you a trigger as to when it's time to buy, when it's time to sell, but there are certain things that ring a bell and we should be definitely paying attention. At the top here, well, let's mention this first. Investors are very long risk and equities are ripe for a correction. This right here just shows you at the top, US, mini S&P 500 index asset managers, institutional short futures, only open interest going down to a level we have not seen before. I mean, just a few instances, and it continues on that trend today. If you look at the bottom here, this is a particular indicator that essentially shows where we're at. If it's overbought, oversold. NAAIM exposure index. This is something that I've covered multiple times before, but you're seeing it for yourself. It has gone into this bubble territory. Other instances, we have definitely been aware of these different peaks, and it happens every single time. We get too overboard and certainly things correct. That could mean a 10% correction. That could mean a 20% correction. That could mean tech stocks start to drop, or tech stocks do well and financial stocks do poorly. It all depends on what's going to happen. But this is just something to keep in mind. That's all. It doesn't mean you should short the market. Doesn't mean you should sell all your stocks. None of that. So just keep your eyes on these different indicators that I show you, and you do what you wish with the information. This one here, all I'm trying to mention is essentially that, they mention it on the right-hand side, investors remain extremely complacent. They give you the different ways, in this case here, the RIDEX asset ratio and so on. They break it down. All I want to note is simply that there is the most risk-taking ever that we have seen on so many different levels. This is just one measurement of that. There's so much cash sitting on the sidelines. Oh no, that's not true. Take a look at this pension fund allocation cash. Does that surprise you? Look at that. That's the blue line right there. It has continuously declined over the last several decades. And that, of course, is because as time has moved on, interest rates have been going down, and these pension funds, they need to get people, let's say 7% return. That's what they have promised. And of course, they can't do that, especially when they're in cash. And now because of bonds, that's why more money is flooding. Institutional investment is flooding into different things, equities being one that has been absolutely seeing the benefits of low interest rate policy. Mutual fund cash level, same exact situation. Interest rates coming down, less cash, and as a result, equities see the benefits. deviation above or below the long-term mean, and that right there is giving you the S&P 500. And right now we are in some pretty insane territory. I will just show you this right here. That is the deviation plus or minus intermediate term moving average. And we've been here before in certain cases. We've been here in, well, looks like hard to tell, around 2009. Okay, if we go back even further, in the 90s, we experienced that as well, and a few other times before that. And these right here just give you some insight, again, like I just spoke about a couple minutes ago, that tell you when things are getting overboard. And right now, that is clearly the case. Okay, all right. I have to cover this. I know I've probably gone on too long, but you've got to hear this information. Anybody who stayed to this point, you're going to get a good one if you haven't seen this Financial Times article. Okay, no more ranting. Let's go. Zero fee trading helps Citadel Securities cash in on the retail boom. Higher volumes and wider spreads have driven outsized returns for market makers. A lot of people are not aware of how this works. When those retail traders are using Robinhood and using these other zero fee different brokerages and so on, there is a reason why they're zero fee. Let's just cover it. Citadel Securities and its majority owner, Ken Griffin, who, by the way, has bought the most ridiculously large amount of houses for his personal possession, I guess, in the last year or two, anyway, are among the big winners from a boom in retail investing, cashing in on zero-fee trading that has lured huge numbers of first-time investors into the U.S. stock market. That's obvious. We've seen the uptick in accounts opened up at Robinhood, and even though some have moved their money elsewhere, clearly the trend was in. Chicago-based Citadel Securities accounts for, check this out, 40 of every 100 shares traded by individual investors in the U.S. That's huge, making it the number one retail market maker. The company is a big buyer of customer trades from the leading U.S. retail brokerages, such as Charles Schwab and TD Ameritrade, which have slashed commissions to zero to keep up with the fast challengers such as Robinhood. So check that out. They are buying the customer trades from Charles Schwab, TD Ameritrade, and others. Citadel pays tens of millions of dollars. This is interesting. Tens of millions of dollars for this order flow, but makes money by automatically taking the other side of the order, then returning to the market to flip the trade. It pockets the difference between the price to buy and sell, known as the spread. This is so big. This is so huge. People do not realize it. They go in, they buy 7 shares of Amazon, they're happy, that's the end of it. But on the back end, so much more is going on. Easy access to the market against the backdrop of wild swings in prices have led to a higher trading volume for stocks and options this year, increasing the raw material Citadel Securities uses to turn a profit. At the same time, the rise in volatility has forced spreads wider, increasing the potential income for market makers. So this is all so important. I wanted to bring it to you. That's all. I'm not going to make any more commentary, but I think it's important to see what's happening with the retail traders and realize there are some really big companies that are profiting off of each and every trade. That's all for this video. If you found it informative, hit that thumbs up button when you do. You're supporting me. By clicking a button on your screen, you support the channel. Thank you very much. If you want to learn about Amazon, you can do it for free. I created this course specifically so that people, when they're asking for solutions, I want to make money, you're this, you're that, they're telling me why they hate me, I figured, hey, I'll create this entire course about what I have learned, I'll give it for free, and then I won't receive as much hate. Well, that clearly didn't happen. In fact, the channel had already peaked out, and well, here we are. Anyway, if you want to learn for free, if you're one of the 9,000 people plus, and it's growing every day, the amount of people that do get in, you can do so at the AmazonGPS.com. If you want to learn about the financial system, you want to understand self-sufficiency, financial education, how to profit, making money, all the details are in these 2 books. You can check them out at the link in the description if you want the audiobook instead, themoneygps.com. Wait a second, hold on. Have you seen this video? If you haven't, definitely check it out, click it, and I'll see you there.